Welcome to Nifty's Targeted PD Seminar Series. The purpose of these seminars is to provide a review in content, instructional activities, and Nifty best practices. These seminars are useful for teachers who have recently gone through Nifty University, as well as for veteran teachers looking for content and teaching refreshers. On this webinar, we will discuss the income statement. By viewing this webinar, you will be able to explain the structure of the income statement, understand the process of building an income statement, and identify Nifty best practices and suggestions for teaching to help students build their own income statements. Before we start discussing the income statement, let's take a moment to review the Nifty units of learning. Students learn about the income statement in Chapter 11.1 of the 11th edition textbook, which falls in our third unit of learning. Although the income statement is a piece that comes closer to the end of this financials unit, it quickly shows an entrepreneur if he or she needs to revisit key decisions on pricing, sales, and expenses. We'll get into this a little bit later in the presentation. Take a moment to review the learning objectives for the Financial Information and Operations unit of learning. You may notice that the income statement is explicitly described in the third learning objective. But the income statement is key to learning objectives 4 and 5 as well. It is the key document or financial instrument used in the Nifty program for students to assess the health of their business. So let's take a look at a simplified version of Ava's Edibles income statement. What does it tell you or show you about Ava's business? It tells you that Ava's products cost $325 and that she sold a total of 252 units of her product. And after expenses, her business earned $10,241. So you can look at this income statement and say that it appears that Ava's Edibles is a profitable business. The income statement, just like a scoreboard, tells a story with numbers, and specifically, the story of what is happening in a business at one point in time. For this reason, it is often referred to as a company snapshot or a picture. It's a powerful tool that helps companies assess if they are buying low and selling high. In our Ava's Edibles example, we learned not only that her business was profitable, but how profitable her business was. She made $10,241. So let's quickly review the parts of the typical income statement. Revenue, that's the money that the business receives from selling products or services. We use total sales and revenue interchangeably. Pre-tax profit, that's gross profit minus the operating expenses or fixed expenses. Net profit is pre-tax profit minus taxes. Nifty uses a tax rate of between 15 to 20%. Variable expenses. These are expenses that change based on the units sold. Cost of goods sold. This includes all of the expenses related to materials and labor that go into producing your product or service. Contribution margin is net sales or revenue minus the cost of goods sold and other variable expenses. And fixed expenses are the expenses of running a business. These are also known as operating expenses. You'll note that in the version of the income statement that Nifty uses, we use contribution margin rather than gross profit. Both are technically correct. The contribution margin format allows us to show students how to use the economics of a unit as the building blocks to the income statement. For us, the economics of a unit includes both cost of goods sold and other variable expenses. The top 3 challenges we see in the Nifty classroom around the income statement and the financials in general are first around math, the actual computation of the income statement or any of the math components. The financial connections. This is around how all the financial pieces from the income statement to the economics of a unit, how they fit together. These all impact the student's ability to present their financials and their confidence in presenting those financials. Students struggle sometimes with the vocabulary. They generally struggle with, again here, thinking about how changing one item in their income statement will impact all of their financials. So in this webinar, we're going to cover how we can build the income statement to help our students feel more confident, as well as practice in the classroom. What are the building blocks of the income statement? At the foundation of the income statement is the economics of one unit. As we described earlier, we structure the income statement based on the economics of one unit. And really, underneath this foundation, there's one layer underneath, which is understanding what the different expenses are. So what are fixed, what are variable, and what are startup expenses. But for our purposes, we're just talking about the main components that build the income statement. The second building block is fixed expenses. Fixed expenses are not directly linked in creating the product or service, but they're incredibly important to be able to estimate as they impact the bottom line in the income statement. And finally, sales projections. Although we do not technically teach sales projections in this unit of learning, students need to estimate sales to create the income statement. They can revisit these projections once in Unit 4, Marketing and Sales. In the next slides, we'll review each block and key areas of focus and consideration in building an income statement. The economics of one unit impacts 4 parts of the income statement: revenue, cost of goods sold, other variable expenses, and of course the contribution margin. If you look at the top part of the income statement on the slide for Lola's custom drapery business, you'll note it looks very similar to the economics of one unit. It's basically the economics of one unit times the total number of units that Lola sold. The key areas of focus and consideration for this building block are related to her profits, so Lola needs to consider the following. Pricing, that's related directly to revenue. She needs to ensure that she covers all her variable expenses, but at a rate that the market will bear. So that means a price that both customers will pay and also is competitive with other drapery businesses. 2, the cost of goods sold. She needs to research and find suppliers that will provide her with good quality product at a good price for materials like cloth. She also needs to estimate precisely how much of that cloth she will use per custom drape. Labor is another factor of the cost of goods sold that she needs to consider, whether it's herself or someone else that will sew her drapes. She needs to estimate the total amount of time that she believes it will take to sew one unit and price that at a fair labor rate. 3rd, she needs to consider other variable expenses. Lola here is paying somebody a commission, so she may be having someone help her sell her products. Commission is a great way to help manage expenses because it's variable. That means that people only make money when they make sales. Finally, she needs to make sure that all these pieces come together in her economics of a unit per unit to make a contribution margin per unit at a profit rather than a loss. By focusing on these items and effectively building her economics of a unit, she begins setting herself up to be profitable, or at least show a profit on her income statement. But as we know, there are more parts to building the income statement. The next building block for the income statement are fixed expenses. Using Lola's custom drapery business, we know that for the month of March, her contribution margin is $46,896. That means that's the amount of money that she has to contribute to her fixed operating expenses. Although fixed expenses seem more straightforward than the economics of a unit, there are some key focus areas that we need to consider. 1, we need to identify expenses and ensure that these expenses are fixed. In some cases, students confuse a startup expense or double count a variable expense in their fixed expenses. So let's take, for example, in Lola's case. She appears to have $12,000 in salaries. She needs to make sure that none of these salaries accounts for the direct labor to produce that product, because that time and money is already included in the cost of goods sold. Labor is one area where students double count, so making sure that they don't is important. Second, many times students underestimate their fixed expenses or think it's good to have less fixed expenses. Excluding fixed expenses, as we know, is not good because it shows that the entrepreneur has not been thinking about what it will actually take to run the business. And it also makes the company's taxable income higher. Make sure your students account for capital equipment or software by using depreciation. This can help to sort of pad or increase, especially small fixed expenses. In Nifty, we use straight line depreciation. That's dividing the value of the item by the total number of years it will last. So for Lola's drapery business, she's likely depreciating the sewing machines that she uses. And finally, students need to think about the time period for their fixed expenses. Not all fixed expenses are actually monthly. Nifty simplifies calculating the yearly income statement by having students look at expenses on a monthly basis, but we know that some expenses can be quarterly or biannually. So let's say that Lola has a cleaning service that she uses that she only needs to pay quarterly, and each quarter she pays $200. Her yearly expense for her yearly income statement then would be $800. But if she didn't remember or didn't think about this expense being a quarterly expense versus a monthly expense, she could end up reporting on her income statement that she's spending $24,000 a year on this cleaning service. In your classrooms, it's fine to have your students still spread the expenses that they have by month, but make sure that they are thinking about what the payment schedules are and when they're expected to pay these expenses. The last building block are sales projections. Of all three building blocks, sales projections are the hardest part because students don't learn about them until Unit 4. It's still important to guide students with questions related to full capacity, seasonality, and break-even without defining the terms fully. You can introduce these concepts with questions like the ones we have here on this slide, and explain to students that we will revisit sales projections and the income statement in Unit 4. The income statement, like the rest of the business plan, is iterative, and explaining to students that they will come back to sales projections again can model the importance of the process of learning over the exact answer. In walking through how to build the income statement, we've also reviewed how these components are interconnected and how, in general, they impact the income statement. This supports students' understanding and analysis of the income statement. Students can better connect and think about how to improve the overall profit for their business plans. Another great tool that Nifty provides for analysis is the Business Plan Excel workbook. The Excel workbook sheets are linked to show relationships. Students can use these to further test and see how changing things like price, utilities, or sales can impact the overall income statement. We recommend using a sample business plan like Ava's Edibles to start with. You can work together as a class and make changes in the EOU, fixed expenses, and sales, and have students guess before you show them about what they think will happen to the income statement based on these changes. This way, once students go to their own income statements, they'll have a deeper understanding of the impact of the decisions and the adjustments they make to their financials. Ultimately, that understanding will impact how your students describe and present their business plans. Now that we've reviewed how to build the income statement, let's look at Nifty's instructional flow and how it all fits together. Experiential activities like the income statement card game and the buying and selling experience are great for computational practice and to reinforce vocabulary, like revenue and expenses. Specifically, the buying and selling experience simulates how to actually run a business and shows students how to use the income statement in practice. After that, you can review and teach content from Chapter 11, Section 1, using Nifty tools like the textbook, chapter PowerPoints, and workbook for additional practice. Next, guided instruction includes using case studies. Specifically here, you can use Ava's Edibles case study in Unit 5. Here, Ava compares what she thought would happen in her projected income statement to her actual income statement. This is also a great opportunity to use your sample business plans and exemplars with the business plan Excel workbooks and test how all their numbers can be changed and are interconnected. To more formally assess learning, you can have students complete Performance Task 3B and assess if students need any reteaching or additional practice. Finally, the ultimate demonstration of learning is your students' ability to complete their income statements in the business plan and explain to you, peers, and judges why they made their decisions on pricing, expenses, and sales. They'll also be able to effectively describe how changes in any of these items affects their projected income statements. To close out this seminar, we recommend the following next steps. Reread Chapter 11.1 for more content review and additional exercises. Review the Nifty University Income Statement PowerPoint presentation. That's Day 2, PowerPoint 7. Review the Financials and Perseverance Targeted Professional Development from last year. This can help you figure out how you can get your students to practice more financials, and that practice will get them more and more comfortable with presenting. Look through the experiential activities and assessments for additional support. The experiential activities have some great modifications that you can use in your classroom. And finally, a great resource is your program manager. Ask them for additional support with case studies, co-facilitation, and volunteers in the classroom. Thank you for viewing this targeted PD seminar on the income statement. We hope you found some useful tools to use in your classroom.